Hey, welcome to another episode of FinSights. Today we're going to be talking about how to retire in 10 years. And no, that's not clickbait, it just takes discipline and a few different lifestyle changes. So first, I need to bring up this Mr. Money Mustache article. In no way do I want to take credit for this. So I will link these articles in the notes below. So what we're looking at here is essentially how much you need to save of your income and how long it will take you to retire based on how much you're saving. So for example, if you're saving 50% of your income, you will have 17 years until you can retire theoretically. And of course, this is based on your current expenses. Okay. And the way this works is they use a thing called Trinity study to figure this out, right? And so essentially, what you need to do is take your annual expenses, times it by 25. When you get that number, that is your FI number, your financial independence number. And theoretically, based on the Trinity study, you can theoretically withdraw 4% of that every year and never run out of money. And this is the most conservative number based on a period they tested. It was like 1925 to 1995. So we had some incredibly rough markets in that period. But overall, they found that if you are only withdrawing 4% a year, then you will theoretically never run out of money. So for example, if you have $40,000 a year in annual expenses, that means you need to save up $1 million to theoretically never have to work again. And this is usually much less than what you'll see on a typical retirement calculator. And that's one thing I wanted to bring up. And I know we talk about investing and trading a lot, but this is simply based on a broad market index fund. This is no strategy involved, really. It's just your savings rate and how long you're saving. And that is how you come up with these numbers. So again, I'll show this in a close-up here. So if you're saving 50% of your income, it'll take you 17 years, 65%, 10.5 years. And then if you can get to that 70% number, 8.5 years. And this is simply based off 7% market return. Now, the only thing that I think differs from my views than the FI community is I believe we can do a little bit better than 7% a year. So what I have here is an investment calculator or a compound interest calculator. And let's say we start with $0 and we contribute $1,500 a month. If you're making $3,000 a month and your expenses are $1,500, this would be, the equivalent of saving 50%. And so if I do the math real quick, 1,500 times 12 is 18,000 times 25. Your FI number is 450,000. Okay. So over 10 years, if you start returning a little bit more than that 7%, let's say it's 22%, and we have a variance range of 5%. So this could range from 17% to 27% a year. Okay. And we see here, after 10 years, we'll have almost 200,000 more than what our FI number was if we had $1,500 a month in expenses. Okay, so what does that look like if we're able to save 2,000 a month? 856,000. What does that look like if we're saving 2,500 a month? 1,070,000. And at the top range, we have almost 1.5 million. At the lowest range, we have 780,000. Okay. So the reason I want to bring this up is because I think we can do just a little bit better than that 7%, 8% that everyone likes to quote for index fund investing. And that's why you're here. That's why you're watching this, to learn to get better. And there are a few elements that we can take control of. We can spend less, we can earn more, and we can invest better. Well, the problem is when the FI community likes to say invest better, all they say is use index funds, use a total stock market index fund, and ride that 7 to 8% a year, and hope that after 20 years you wake up and have a heart attack. That is the only thing I would disagree with. I think we can do a little bit better. And you can see if we're just doing 22%, and the reason I have this number is because that's a tested return on one of our most conservative strategies. So if you're able to get just 20% a year, you can see in 10 years, if you're able to save at least half your income, depending on what your expenses are, you can easily hit your FI number. And so personally, I'm on track to do that within the next 9 years. 2029 is our financial independence year. We're hoping to hit that number sooner, but that's right now how we have ours projected, and that's based on this number here. Obviously, things can happen with the stock market, and we could see a 10-year bear market, but realistically, based on some back testing we've done with our strategy, I don't see that happening, because the back testing period, for example, here was from 2001 to 2018. So we had two of the worst bear markets in history, on top of a horrible year to end on in 2018. Okay, and the way this works is essentially you're going to divide your portfolio up into 4 different quadrants. Okay, and so you're going to allocate 25% per stock purchase. And what I like to do personally is I have 3 of my own strategies, and 2 of them are not public, and then this one is something you can follow on the Patreon, and then that's going to be patreon.com/finsights. But this is a public chart list, and I'll have that link below, and you can try and follow along here, but I know it probably makes it easier if you're able to follow along in real time when I post what stocks we're finding. But essentially, what you do is I run a scan for a stock list I have, blue chip stocks, mostly aristocrats, and then I run a scan, and based on where their weekly stochastics is, I will make a purchase and then immediately set a limit order for 5% above my entry price. Okay, so we buy when the blue chip stock is below 20 on the weekly stochastics oscillator, and then we sell when we have 5% profit or we've held it for a year. This is the more conservative way of doing this, and this is what was returning 22% a year. So the way this works is we're taking advantage of compounding, and we're using it to our advantage as much as possible. So we're taking small profits over a long period of time, and as we take those profits, our money compounds even more than if we just leave it in the market. And so this strategy says, divide your portfolio up into 10 different sections and use 10% per trade. And if we see here, it says not for the faint of heart, but I think the max drawdown for this was 18%. So if you change it to 4 stocks and 25% allocation, your returns over this period was 22.71%. That is exponentially more than what the stock market returned. And if we can achieve those returns, we can hit our financial independence number much sooner. And let me show you an example chart here before we wrap this video up. So again, we can see this is a treasury bond chart, but it still works on treasury bonds. It works essentially on any blue chip or any stock that is trending up. And this is based on an algorithm we wrote that scans for these particular stocks that we like. And like I said, this chart list is available, and all the stocks that come up on our scan, I upload and I keep updated here. And you can see this is below 20 on the weekly stochastics. The price is down here, and we're just looking for that 5% bump, right? And these are all blue chip stocks. So we got Aflac. This is one of them. And of course, this was a great week. If you're watching this in March, you know that we just had a crazy 12% decline in the market. We got Anderson's. These are all some sort of blue chip stocks. All right. I'm not going to go through every single one, but these are the ones we have on the list. Okay. So if we go back to this example, the way this works is we're essentially taking a very oversold stock that is a blue chip stock that is not likely to go bankrupt over the next couple years. And we buy it when its stochastics is oversold on the weekly chart, which means it's below 20. And then we set our sell order for 5% above our entry price. So you can see here how this has worked out each time. TLT has dropped below 20 on the weekly stochastics. We bought in, then we set our limit price for 5%. You can see it's worked out every single time. Right? So the reason we have a max holding period is because we do not use stops for this strategy. The reason for that is we are buying blue chip stocks. So worst case scenario, we could hold one of these stocks theoretically forever because it's a blue chip stock, and that's why I scan for them ahead of time. And then by having a holding period, we are cutting our losses after 365 days. And the reason we want to do that is just so we can continue that compounding effect. And when we have compounding, every time we make these trades, we're making about 30 to 40 trades a year, which is not a lot, but we're compounding exponentially. We're making these small 5% gains over and over and over. And that allows us to achieve this 22% a year rate. And that's how you essentially can retire in 10 years or less. I hope you found value in this video. And we're going to have a lot more videos going into depth why we don't use stop losses, and a little more in depth about this strategy in particular and how we pick our blue chip stocks. All of that is going to be on the Patreon. You can find that at patreon.com/finsights. And I'm also going to link it below. So again, I hope you found some value in this video. I hope you learned a new strategy you can use on your own, maybe tweak it on your own, see if it works better for you in a different way. But this is free. The public chart list is free. So feel free to head on over and give it a follow. And if it works out for you, let me know. Just know that this is a very disciplined strategy, and just try and save better and spend less. Have a good one.